Hi, I'm Lauren Sercu, and I'm a managing director at Sepio Capital, which is a multifamily office and institutional advisory firm, and I lead our impact investing practice. Today, we're going to be talking about the tremendous growth we've seen in sustainable investing. And anytime you have extreme growth, you have very positive outcomes and some pain points, which I think is true for the growth in this industry. I'm thrilled to be moderating this discussion between our two exceptional panelists. I'd like to welcome Marisa Drew, who is the Chief Sustainability Officer for Credit Suisse, and Chris Lees, who's the lead portfolio manager for a number of strategies at J.O. Hambro Capital Management. So I'd like to start by having both of you introduce yourself and sharing how your journey with impact or sustainable investing started. So Chris, why not we start with you?
Oh, thank you very much, and thank you for inviting me onto this call. I've been, I think, best described by my clients as a Trojan horse for sustainable investing for more than 30 years. I've operated within mainstream finance, first at Baring Asset Management, and then at J. Hambro Capital Management. And I'd like to thank my mother who brought me up with it's really just common sense. And that slowly I've been able to show mainstream finance that it's good common sense. And the 30-year journey continues. So thank you very much.
Wonderful. And Marisa, we'll turn to you. Tell us a little bit about your story and how you began in the sustainable investing field.
Sure. Well, I can't claim 30 years in sustainable investing like Chris can. I'm in that context a relative newbie to this whole thing. I also, though, have had a 30-year career in finance, have had time in private equity, but most of my career has been in investment banking, with a job that was right before this one, running investment banking for EMEA, Europe, Middle East, and Africa for Credit Suisse. And I've been at Credit Suisse for about 18 years. And during that time, I've also run all of our capital markets businesses. And I think of myself as principally, with the bulk of my career, raising capital for early stage, high growth companies. And it's pretty instructive in many respects in terms of my journey in the sustainable finance arena. But I say that I'm a sustainability convert almost by accident, because I was in a meeting and I got a fateful call 3.5 years ago from my group CEO that asked me to come see him in Zurich because there was something on his mind. And I always laugh and say, when you get a call out of the blue from your group CEO of a large cap company of 45,000 people, the first thing you think is, uh-oh, what did I do wrong? But in fact, it was to actually have a discussion about this topic that was increasingly surfacing in the conversations that my CEO was having with our various client segments, all of whom were grappling in some way, shape, or form with trying to create values alignment with their investing habits, or putting money to work in environmentally or socially proactive opportunities, or in the case of our corporate clients, wrestling with changing consumer demands and habits that were asking things of those companies that they had never asked before. In any case, my CEO said, there's something here, we're in a position to respond to it, and I think you should run the business. And I was, came out of left field. So that's why I say I was sort of almost by accident thrust into this world. But I started out also as a cynic, being in the markets for 30 years, saying, is this some sort of CSR thing, meaning sort of something that would go in a marketing report? Could you really demonstrate that there was there in terms of robust fundamental analysis and performance and returns and all those kinds of things? And I needed to satisfy myself of that before I was ready to take on the challenge. But I did, after that exercise, come out the other side being very, very convinced that we were in something that was here to stay, not just sort of a market cycle or a market fad, that it was robust, it was serious and necessary. And that began my journey 3.5 years ago. And fast forward today, who would have ever thought that we'd be in the position that we are in the sustainability field just that's such a short time ago.
Excellent. Well, thank you both. And again, thank you for being here. Let's dive right in. I want to talk a little bit about what the process looked like for getting each of your, large global investment firms to commit to scaling sustainable investing. And specifically, would love to hear about any roadblocks that have come up. So Marisa, maybe we start with you. have you been met with any resistance? Have there been roadblocks along the way in sort of these first 3.5 years?
How many can you name? So I laughingly say I went from having this big business, big budget, 1,000 people under my wing to effectively having a startup. So it was myself, my assistant, and a white sheet of paper when we started. So that in and of itself was a pretty big challenge. Not that there wasn't activity going on at the bank, but it was very much in little pockets sprinkled all over our very complex global organization. Because prior to that time, nobody had had the mandate to think about this strategically and holistically. So the first hurdle was actually finding out where activity of sustainability existed. And the more digging I did, and it was remarkable because I was there with the mandate of the group CEO, it was quite a visible thing. But actually, I kept finding myself almost stumbling onto areas where we were doing really great things, but we had no way to talk about it or communicate it across the bank, no way to share best practice and so on. So that was the start of the journey, I'd say, is almost collating all of this. And then the second biggie was raising awareness and trying to capture the hearts and minds of my peers in particular. Because in a bank, particularly a wealth manager, in many respects, we have a big investment banking practice, but a very, very big private bank. And when you're dealing with those who are dealing with individuals, we call them RMs or relationship managers, rightfully so, they're very protective of those relationships. And they needed to be convinced that this was either real or that it was going to generate proper returns. They also needed to be facile with the topic because I think most client coverage people don't want to talk about something with their clients that they don't feel that they understand. Nobody wants to look dumb, if you can say, in front of your clients, but also as a fiduciary matter, they needed to be really convinced that it was real. So I say the first 18 months was being the annoying person in my organization that was the agitator. Constantly trying to raise awareness and pushing and pushing and pushing, sometimes with a carrot, saying that look at all the opportunity you can create if you can connect with your clients on the topic, because there's just so much here that will develop into a deep dialogue with clients, particularly on a personal level, about values investing and what does your family stand for and what legacy do you want to leave and all those sorts of things. But also, strategically, every now and then when you're trying to agitate for change, you got to use the stick. So the stick piece of that was, if you don't do it, somebody else will engage with your clients on the topic because they do care. And about 18 months in, I think we hit an inflection point, and we went from me always pushing to being a pull factor. And as I say, look where we are today with this being, it's almost impossible to enter into conversation with any type of client without the concept of sustainability coming up in some form or fashion. So I do feel like that was a moment when it tipped over into they were asking me to engage rather than the other way around.
So interesting and very well said, Marisa. I think many folks who are going to be listening might feel that they're at that inflection point as well, and kind of transitioning from feeling like they're pushing to getting pulled by clients. Chris, what about you? You were one of the few and perhaps the original ESG proponent inside a purely financial firm. What was that like, and how has that changed over time?
Well, that's very kind of you. Thank you very much. I think Gandhi says it much better than I did. And remember, Gandhi's quote says, first they laugh at you. And that's what they were doing 30 years ago. And then he said, then they fight you. And, boy, oh boy, has mainstream spent 20, 30 years fighting. And then they join you. And so we're at that point where mainstream is joining us. And another way of articulating it would be that change is often very slow, and then it happens all at once. And we're living through that moment of, and then it happens all at once. For us that have been fighting for it for a long time, as I said at the beginning, it's actually common sense. So initially, specifically, the roadblock was showing people one by one that it improves your risk reward. Ultimately, I have a fiduciary duty to my clients. By law, I have to reduce risk and increase reward for my clients. And I'm a quantum mental investor, so I use quant and evidence-based to start with. And it's very, very clear. And initially, we used sustainability and ESG because it reduced risk, and we had the data to prove it reduced risk. So we could win the battle first on risk control. And actually, from around about 2015 onwards, it began to increase reward. And we call that a fourth dimension. The fourth dimension in science is everything changes over time. Specifically with investments, everything gets arbitraged away over time. And understanding that different factors come into play, and this factor, the sustainability, the ESG factor, it morphed from being a risk factor to a full-on reward factor. And you've seen that more and more from 2015 onwards, the market actually rewarding companies that are pivoting to what we would call clean and green growth. And those pivots, those transitions, are often where we've been able to make the most money for our clients. And so you go through that journey, slowly educating the firm around you, plus the end clients, that, hey, regardless of your views, we can actually increase risk-reward trade-off here. One by one, the roadblocks fall.
By the way, I have to say, Chris, I love the first they laugh at you, because I remember when I left, running banking, I had a few people say things like, wow, I thought she was a serious business person. What happened to her? Or she went over to the dark side. So there were those kinds of comments floating in the hallway. So it's not quite the laugh, but it was certainly the what happened to her. And I also concur 100% that, in the maturation of any market, having been through so many market cycles and so many phenomena where you started out with something that was something new. So much of, I think, market adoption is about proof points, right? Demonstrating that it really does work through the cycle, through different points in time. And that's really, I also concur that that's sort of where we are now, right? We've got enough proof points through the cycle in times of market shock and good times and so on, that performance really can be demonstrated across asset classes too.
So excellent points from both of you. And I think let's dig a little bit deeper into, I feel like we can all agree that impact is going more mainstream. A lot of folks are joining this movement, but there are still some naysayers. And I've been asked questions like, isn't ESG a premium that will fade over time? Or is sustainable investing a fad that has become overcrowded? So Chris, maybe we start with you as someone who's been incorporating ESG analysis into your investment process since way before it was cool. What are your thoughts on that?
Yeah, the short answer to those two is in small pockets of the market. Absolutely, yes, you're right. Small pockets of the market, certain companies, certain themes, certain positive impact themes and stocks have been bid up to premiums. In others, no, it's not happened yet. So keep looking for where it's not happened yet. We call those the transitions. I would say avoid the very expensive, obvious first order, second order winners. I won't name any names, but you'll probably know a couple of the stocks I'm referring to, and go look for who's next. Go look for the companies that previously used to not care about this or used to be explicitly dirty companies that have done a complete 180-degree pivot. And there you'll find a company that's really attractively valued because the market hasn't noticed yet. And that's where we're seeing the greatest opportunities today, those transformations. So yeah, there's risk and reward, isn't there? You've got to avoid the bubble stocks, and you've got to look for the stocks that have got the better fundamentals and the revaluation ahead of them. But really, the overriding answer to those people is: do you really want to be on the wrong side of history? Do you really want to own railroad stocks? Do you really, when the airplane's invented? So, as my mother would say, don't fart against thunder. It's a pretty pointless thing to do. You really want to tilt your overall portfolio to be on the right side of history. There are going to be some devastating value traps on the wrong side. And it's interesting that no one talks about that. Your question was framed about, is there a bubble here? And yes, there are small bubbles in small areas, but nobody talks about the stranded assets and the value traps that are going to be left behind. And that's what you wouldn't want left in your client's portfolio. That's not going to be a happy ending. That would be equivalent of when the Model T Ford was rolling off the production line. That would be the equivalent of saying, hey, these horses look really cheap, I'm going to buy some horse companies. At the end, they were cheap for a reason. So we are having a very, very big transition. It's probably a 10 to 15-year transition. There will be some bubbles that come and go. There'll be some sustainable new, some winners that we can lock onto. and there will be also some value trap, stranded assets that, they sit in people's portfolios, and you probably want to weed them out gently.
Excellent points, Chris. Thank you. And it does seem like a lot of this is simple investment principles around things like risk mitigation and protecting the downside for clients' portfolios. Marisa, what thoughts do you have? You mentioned proof points earlier and how important that is for advisors at your firm to buy in. What kinds of proof points have you been able to offer naysayers that might be out there?
Sure. Well, Chris is pointing to just good, sound investment fundamentals, right? That you don't chase overheated stocks, and you have to look out for where things may no longer exist, and that's trend style investing. And so, to me, ESG investing is no different in many respects, right? So, I guess rather than overcomplicate it, what I also say, and Chris, I think, said this as well in his opening comments, that to me, sustainable investing in many respects is just a tool in your toolkit to have a different lens through which to do your fundamental analysis. So if you take the E and the S and the G into consideration, it helps you have it changes your aperture of how to look at risk and opportunity. It doesn't mean that everything sustainable will run and outperform everything else over time, nor will it also avoid every risk. I think it's just one of those things that you have to think about it in that context. So then when you think about the proof points, I think we also have to be a little bit careful. So we had a wonderful run during COVID. Virtually every sustainable fund outperformed. And it didn't matter whether it was a generalist fund or whether it was thematic or what have you. You could pretty much see the outperformance occur both at a time and then moment of acute shock. So when we were at the real bottom, in March of 2020, and then you also saw that outperformance happen through the recovery. Now, there's so many ways that you can skin this onion, as we say, right? You could say, did you just get lucky in generalist funds because you weren't holding fossil fuel stocks, and when the oil price shocks hit, you avoided that? I think there's an element of that, and we have to be cognizant. But if you peel back that onion further, what we saw is what I like to point to is ESG leaders versus laggards. So the highest ESG rated companies by industry almost linearly outperformed the laggards. So if we take an industry like healthcare, by definition, there isn't fossil fuels in a healthcare strategy. You saw the leaders outperform the laggards and on it. So I think all of those were great. But what's happened is, and I think this is a great thing in many ways, is that it fueled the enthusiasm for more capital to flow into sustainable strategies. But then you start to get the phenomenon where those leaders could be overbid. And to Chris's point, then you are ultimately arbitraging away that outperformance. And then what you need to do is look at maybe something like the ESG improvers, because maybe there's more alpha to be created in those who are on the journey to improve rather than those who are, say, already green. So, but that gets back to then saying, let's not say this is the be all end all. Let's say, let's use this as a tool in traditional investing theory, which has been proven over many more decades than even Chris's 30 years, that it actually works. So it does lead you to say, it's a lens, but then let's not avoid good, strong fundamental analysis. But then to the proof points really quickly, there are so many, because it's this leaders versus laggards. It is what is necessary. So one of the things I point to in terms of where to find value is look where money is by definition going to need to be spent, say to mitigate climate change. That in its own right will create huge value opportunities. I love to give the example when we woke up one day and China said they're going to ban petrol cars in X years. What did they do by that very one statement? They created a multi-hundred billion industry in China for electric vehicles, whether the OEM manufacturers, components, parts manufacturers, electric vehicle infrastructure companies. Those obviously, because that's by definition where trillions of dollars are going to be spent, follow the money, and that's going to create value. I also say another place where you think about proof points, and we've seen it, is when you see a company solving an intractable problem. By definition, they're creating their own sustainability because it's necessary. It's not that the world was sitting around waiting for a plant-based alternative to the burger. But what that is doing is saying, I'm solving an intractable problem, which is I want a commercially viable, good substitute where the consumer doesn't have to have a compromise, and yet it's infinitely environmentally more friendly than perhaps the way we're growing beef and livestock. And there are so many examples of that. And that's why I say if you use this ESG lens, it leads you to some pretty interesting places, from the disruptors to the improvers.
Thank you, Marisa. Excellent, excellent comments. This has been a phenomenal discussion. I want to close out with kind of a higher level thinking question. I think many of us would say that we will have succeeded when impact investing becomes investing. Do you agree with that statement? And is that possible at your firm and globally? And would love to also touch on what does success in impact investing look like beyond asset inflows? Chris, do you mind kicking us off?
Yeah, certainly. Thank you very much. Yeah, I'm a great believer in system change. I've been fighting for system change from within. Other people fight for system change from without. Actually, you need both. And the better outcomes are because the system's now focusing on outcomes for all stakeholders. The system only used to focus on shareholders 30 years ago. And so we're already seeing better outcomes for clients, better outcomes for companies themselves. They're nicer places to work, better outcomes for people, societies, and better outcomes for the planet. So we're making progress, and it's accelerating, which is very exciting.
Thank you, Chris. Marisa, what about you? What does success look like in the impact investing field?
Sure. And I guess I would be slightly more provocative in saying on this mainstream point, meaning that it will become the only or the first. I think some of this might be definitional, but I do believe that in the not too distant future, sustainable investing will just be the baseline. We won't talk about traditional and sustainable, sort of what I'd say running an ESG screen over your investments as using that tool that we talked about will just become baseline good hygiene. I am a little less confident that impact investing in its truest definition will become, the only thing or become that same baseline, because at least in our definition, when we talk about impact investing, it has to be intentional. You have to be willing to drive outcomes with your capital, measure them and report on them. Not every investment can do that, in my opinion. Some it should just be a screening out or a screening in. Some can just be a passive investment where you're following a theme or a trend, so you're not actually driving that change intentionally. So again, definitional. But success to me is when, number one, we do reach the ESG becoming mainstream, and we're rapidly growing there. Frankly, it's not just because we think it's the right thing to do in the investment community, but thankfully to the regulators who are pushing us in that direction. I mean, they're basically saying, in the EU as an example, it's part of your fiduciary duty, or they're requiring us to take it into consideration in everything that we do as a financial services provider, as an advisor. So I think we're fast approaching that space. But where I guess I would say success ultimately lies is when we genuinely get the investment community to always think about the impact of what capital does. Because if you think about that up front, then it is going to drive that system change that Chris talks about, and it's going to drive behavior, and it's also going to result in outcomes. And that's what we so desperately need right now, whether it's social or environmental outcomes. We need that to happen for a better society for all of us, right? That's I think what we're all mission aligned and hoping to try to achieve here.
Very, very well said. I think we're hoping to see and affect systems change through having a world of investors who are thinking about the outcomes and the impact of the decisions that they're making with their dollars. So with that, I'd like to thank both Chris Lees from J.O. Hambro Capital Management, as well as Marisa Drew from Credit Suisse for participating in this keynote conversation.
Pleasure to be here.
Thank you.